You know that feeling when someone shows up for you just when you need it most? That's what Uber is all about. Not just a ride or dinner at your door. It's how Uber helps you show up for the moments that matter. Because showing up can turn a tough day around or make a good one even better. Whatever it is, big or small, Uber is on the way. So you can be on yours. Uber, on our way.
Reality radio for a really great future. We're talking real money.
Well, we're here to talk about money. Thanks for joining us in our little money chat. I'm Don. That's Tom over there. And this is the Talking Real Money podcast. So glad you decided to download us. Have you enjoyed being downloaded, Tom?
Yeah, it feels so much better when it's done. It's validating in so many ways. It's just,
the initial process is a little painful, but you get used to it.
I shiver, I shake
it's
at the
compression.
end.
I've got to tell you, it's the audio compression that hurts. Oh my God.
What a relief. Yeah, thank you.
Anyway, hi,
welcome. At my age, that's amazing.
Welcome to our little get together. We're so glad you're there. We're going to talk about money today. Surprise, surprise. But what are we going to talk about? Well, we're going to talk about fear and loathing and doing the things that you do with your money. It's a topic that's come up a lot lately, and gee, we wonder why. Do we know why? Oh, we know why. Yeah, we're going to get to that in a minute. But we love the information that comes out of people like, well, Morningstar and Jason Zweig and his stuff. But one source of really powerful research and information, and they don't publish a lot of it, is Vanguard. Oh, Dimensional Funds, another one, another great resource.
Avantis does some good work too.
But
they've got a great podcast. Because I was on it.
Because you were on it.
Oh, is that? But okay.
Yeah,
all right, fair enough.
Oh, gee, Stacking Benjamins has a great podcast. Because okay, they do, but
because you were on it.
Because I was on it. Anyway, the whole thought. It's this thought of building a portfolio and then leaving it alone in good times and bad. It's the tough one is the bad. Leaving it alone in good times. We got that down. Oh, we're good with that. It's the bad times. So should you create a portfolio and basically just, as they say in this Vanguard article, set it and forget it?
Yeah. And by the way, in the good times, and you can remember this, people want to borrow money to invest in stocks, right?
When I was a kid in 29, they were...
No, not that. I can remember people calling us in the late 1990s saying, hey, I'm going to borrow equity from my home and invest it in stocks because the market
AOL.
only goes up.
I'm going to buy AOL.
Yeah.
Anybody remember what happened to AOL? Do you remember?
Can you make that sound it makes?
You've got mail.
Okay, so... But now, yeah, it's about volatility. Now it's about, well, let's see. Would it make more sense to sell my stocks, put money in cash and ride out the storm, right? Because it's been, well, fairly turbulent. Is it different this time? This is something that comes up every time. Because remember, it was different in 2020 because we never had a pandemic. Well, except 100 years earlier. It was different in 2000 because we never had a meltdown about a particular sector that led the market down. Except that had happened before. You can say it's always different, the cause, but the volatility
is always different.
Yeah, yes. Fair enough.
Volatility, but as we've said before, though, volatility is the price. It is the cost of admission to the market. It is why you would have, over the past 100+ years, gained a much better return on your money than you would have with bonds. It's the volatility that is the cost of those added benefits, that money bonus you get.
And this time, I will admit, I can never remember a circumstance where one person can get up in the morning and say, I'm going to do this, and the market either goes way up or way down. I have no recollection of any individual having that control.
And I'm going to get myself in trouble again. You're referring to who exactly? Because I always catch the grief for these comments. So who are you? Who are you referring to?
I'm the middle child here, so I'm just trying to get along with everybody. If that's okay.
You see,
kind of works.
Being the eldest child, I'm the one who always got into trouble, or I made the little kids get in trouble.
All right.
But the fact is, I get in trouble anytime I say, I've got to tell you, a lot of what we're struggling with in this country right now is presidentially induced.
Yeah, okay, it's the head guy at 1600 Pennsylvania. You can do the math. You can
say what he is at least.
He's the president of these United States.
So my very conservative friend Tom, who's far more conservative, I am very middle of the road.
Conservative.
You're much more conservative than I am.
No, I don't think so.
Okay,
we
you're
can
more
do a litmus
conservative.
test. I'm more, but more. not very. I wouldn't say very.
I mean, I voted for Reagan.
Yeah. I voted for Reagan too.
So
yeah, okay. There you go. We're not going to go down this path, but I will say.
Well, you have to because people are going to accuse us of being deranged or something.
We've said this. I do not favor nor believe in tariffs. I don't think they help.
I think free trade's a lovely thing.
Yeah, me too.
As does the editorial staff of the Wall Street Journal.
As do most, as we said, economists. We're veering here.
No, we're not.
Yeah, we are.
No, we have to cover it because we need to parse. We must parse.
But okay, you're
all right. Go ahead.
Listening. You've got significant money invested in stocks, hopefully diversified, because we just saw a portfolio where $2 out of $3 were invested in 3 stocks that have gotten pummeled this year. Literally pummeled. I mean, and you know which 3 we're referring to. And you're calling us and asking us, well, maybe I move it to the sidelines and kind of wait all this out. I'm tired of the turbulence, et cetera, et cetera. Is that a good idea? Well, our friends at Vanguard, among others, are people that have looked at all these things with fair amount of detail, looking back quite a ways, and they point out a couple things that are very important. First of all, the best and worst days often happen pretty close. In other words,
exactly. Like many of the best days in 2008, or actually in the 2000s, happened between October 2008 and February 2009. Many of the best up days were during that huge decline.
People have a tendency to forget that. That's one thing. And so you miss that. And the other part they point out, very importantly, is that if you miss a few of the big days in any period of time, whether it's 5 years, 10 years, et cetera, you can miss a lot of the market return, a whole lot of the market return. So it might feel good when, well, the market went down 2% yesterday. I was out of that, but then it turns around and, gosh, what do we have? The one day where it went up like 5%? It was some ridiculous,
some huge, and that's number. Again, those numbers are indicative of what we see when you just, and it doesn't take very many days. I mean, Vanguard's got, if you miss 10 days, if you miss between 88 and 2024, if you miss the 10 best days between
1988.
1888?
I don't know. You're a long-time market observer.
2024. Your return fell by more than half.
I mean, that should tell you everything you need to know. Okay. So, but
10 days.
You're like my dad. My dad hated when we managed his money a long time ago when he would call and say, what are we going to do? And I'd say, not so much. But now buy and hold doesn't mean set it and forget it. We've discussed this many times on the program. So, for example, I just asked our folks back in our trading. No, you wouldn't like to call it the trading desk because then that sounds like they're back there.
Yeah, well, but they are making the trades because we do buy and sell things. We don't market time.
Yeah, and we don't do it according to how we feel. We have a disciplined approach, but they have been selling, guess what? Some international funds and buying some U.S. stock funds, and they've been selling some bond funds and buying some U.S. stock funds.
Wait a minute. Shouldn't I be buying the international markets because they've been doing better than the U.S. markets?
And not just a little better, by the way, significantly better. There's about a 20% difference between the return year-to-date of the S&P 500 and the return of international small-cap value stocks.
Wait,
20%.
I thought everything moved in lockstep.
Yeah, well, lockstep is there's one stumbling or something or falling down because you should be, if your portfolio calls for it, rebalancing. You should be buying from or
So
selling the
that's
things have
not
gone up.
setting it and forgetting it.
That's correct.
That's setting it and adjusting the thermostat.
And it has nothing to do with how you feel.
Mhm.
Or how you think the future is going to look, because everybody has an idea of, whoa, how this is all going to be different by summer or fall or whatever. You don't know that. You have actually, in this case, day to day, because as we said, it's been very inconsistent.
Tom said that. Tom said that. Send your letters to Tom. Tom said that.
All right.
Not Don. Don did not say that this time.
Rebalancing. Yeah. Very important thing to know. But anytime your life circumstance changes, not the market circumstance, not the economy, not the tariffs, not the politics, etc.
Wait, hold on. Some people are going to respond to that. Well, my circumstances have changed because now I feel differently.
Well, that's a different matter.
Okay.
Yeah. Feelings have no place in all of this. You have a portfolio. You have properly been vetted for how much risk you need to take, how much risk you can take. This is what you're finding out now, by the way. Many people think, oh, as you said, Don, everybody's happy when stocks are going up. And then when they go down, wait a minute, they could go down? Yeah, they could go down a lot. So if your life circumstance has changed, oh, I'm going to retire in a year. Oh, I'm going to need cash for something. I mean, if something is changing in your life that requires a difference in portfolio design, we're okay with that. We're not okay with the people, and you're not alone, because the numbers we've mentioned this on a recent podcast. The number of people that made transactions, for example, in their 401ks up dramatically. The amount of money pouring into gold exchange traded funds up dramatically, et cetera, or chasing performance, as you mentioned, Don, in international stocks. We've seen that. So change in your personal life, yeah, we're okay with that. Number two, and I think there's a movie called this, Tune Out the Noise. Isn't there one, something like that?
Oh, that dimensional thing.
That dimensional thing, which you can go, and somebody wrote us and asked us about it, by the way, said you mentioned on the show. You just simply go to YouTube and type in Tune Out the Noise, and you can watch it now free. It has like 5 million views or something in a month, and a lot of people have watched that. So it's substantial. More than our videos, right? Barely, but still close. No, not close. Okay.
Close, yeah. No, not close.
Decimal point there somewhere.
A decimal point.
Because you need to learn how to do that. Because if you were to listen to the media right now, you've been wiped out. Right? This is the headlines, the yelling, et cetera. And yet a balanced portfolio is down. I just went downstairs and got my tin cup out, broke it out because I'm going begging later.
You're
going to have to go further than the front yard there, because I don't think you get that many visitors. By the way, I'd have to do the same. So don't listen to it, because they're going to tell you that the end, if it's not here already, is certainly near.
The end is nigh.
Yeah.
The end is nigh.
And so
repent, sinners.
You got to get rid of that stuff. And then, as I also mentioned, in times like this, you do learn who you really are about stocks. Some people, by the way, I've met them, should not be invested in stocks. They can't take it. They can't take the ups and downs.
They should be a little. They should even those who can't should have 10% in stocks.
All right, when
you look at the numbers, you have to beat them up and tell them that.
I try to.
And before we change topics or go off into some questions, I just thought, I was thinking earlier, you and I were talking on the phone earlier about Herman's Hermits and the song Henry VIII I Am, and how it became, I've been humming it all morning now that we did that. Now we did that. So I thought, it occurred to me, I was thinking, actually, I think I was thinking this in the shower. We remember music. So I asked ChatGPT.
Put some music to the market decline?
No, to write up some lyrics so that people can remember what we're talking about.
Oh.
And here's what it came up with. And
Mrs.
I don't have
Brown,
music
you have
to
a
go
lovely
with that.
daughter?
Yeah, no. Clueless is smart. The market won't care. Stick to the plan and always beware. Low cost, widespread, futures unknown. Buy, hold, rebalance. Leave timing alone.
That is really good. Every time you do one of those, I think I'm that much closer just sitting on my dock reading a book, because that's really
I didn't
good.
come up with a tune for it because I'm not a music writer, but I could. So anyway, that pretty much sums it all up. So the heck with us. We're just going to have ChatGPT
That's what I'm saying
to you.
The sun's coming out. I'm gonna sit on my dock and read my book. So okay, but if you're worried,
Is there more? I thought that said it all.
You should. If you're worried, here's another idea: talk to a professional. Because guess what? No, not that kind of professional.
I'm sorry. I thought you meant time for therapy for you.
Well, that might be correct. Talk to a professional. Get some help. Have somebody look at your portfolio, because when I look at people's portfolios, they're generally and this is nothing new. They have too much in U.S. stocks, too much in big stocks, too much in individual equities, and most of the time they're taking more risk than they want or need to. That's the part that gets overlooked in all this.
Absolutely. So, the help. As a matter of fact, talking about professional help, and I was joking when I said seek professional help.
I'm sorry I said that.
That's from a pharmaceutical ad right there. If your portfolio doesn't last as
Only
long
take
as you'd
two
like
before noon, because you won't see the evening.
I was going to say, if your portfolio won't stay up for more than 4 hours, consult with a professional.
Okay. Well, I'm glad this is not a visual program. Let's just leave it at that. Okay.
But anyway, I was going to say something. Oh, a good professional will, in fact, act kind of like a counselor, a therapist when markets do this. They really should.
We do a lot of that work here.
But as a matter of fact, the other day, just like 2 days ago, my lovely, lovely wife was saying, I knew it. We should have sold a while ago.
And you went back to your room and shut the door.
I went, dear, do you know what I do for a living?
Have any idea?
Do you know how many people follow and believe what I'm saying? How is it that you don't?
Yeah, well, come on. Really? You're asking that question?
I said, you know what? I'm going to have Tom call you. No, don't. I said, no, I'm going to have Tom call you, because apparently you won't listen to me.
She will listen to me. So
she won't listen to me.
By the way, we are so popular that our shirt appeared in a recent photo at Everest Base Camp. Mount Everest Base Camp.
You've got to be joking.
I forwarded it to you.
Wait, I didn't. There was nothing there. You are a terrible.
You got to scroll over. Yeah, you got to scroll over.
You're
on the
a terrible
picture.
forwarder.
No,
you can just copy and paste the picture.
I didn't do that.
Wait, you mean the
keep calm,
and retire strong?
That's right.
It went up to Everest.
It's the highest honor we've ever received. That's what I said. I thought that was pretty cute myself. So.
I'm so excited.
That was awesome,
because that was my design.
Thank you, our friend Chris, for hauling it up there. So,
so
he's our age, and he's like doing this stuff. I mean,
it's so funny.
All right, his bike halfway across.
Do you have questions for
I got questions.
Our patient audience?
Yeah. All right. Thank you, Chris. And sorry, Don, about the photo. Okay. Technology is not my thing. We know that. All right. I did the best I could. Go back and look at it, though. Maybe it'll work. All right. Andrea writes us from Chapel, Florida. Where's Chapel, Florida? Do you know?
There's a Chapel Hill, Florida.
Just says Chapel, Chapel, Florida. Don't know it. Now, this was written a day before the tax deadline. So keep that in mind.
There's Wesley Chapel. That's got to be it.
Oh, it is Wesley. Pardon me.
Wesley Chapel.
I'm not doing my best work today. It is Wesley Chapel. I apologize. So what part
Wesley
of the
Chapel is northwest of Orlando, northeast of Tampa.
Okay. So
it's a Tampa suburb. Really.
Now, remember, this was written right before the tax deadline. So
April.
We can't help you
middle of April
specifically with this year. Last year, 2024.
Shouldn't we hold this till next year?
No, we're going to do it because we're going to make sure people are aware. But she said, I haven't worked this year yet. Can I open a Roth now based upon last year's wages? I plan to resume working soon and contribute a second time for 2025. I'm 62. It would max both using inherited money, which is why I don't want a traditional IRA. Okay, so you can make an IRA or Roth contribution for the previous tax year, 2024, which would have been right up to the tax deadline.
Which is April 15th.
Yeah, which is come and gone.
It's done.
It's done. You cannot do that in an employer-sponsored plan. You can only make that in the tax year of which you're in. So there is a difference there. So in your case, Andrea, you're stuck with whatever you can make in 2025. You have that ability all the way till April 15th, 2026.
For the personal ones.
For the personal one. Right.
Yeah.
Correct. So keep that in mind. obviously, the earlier the better because it gets more chance to grow. But
Yeah,
yes,
that's the
you can
thing.
still do
The
it.
earlier you can do it. I mean, if you could have done your 2025 on January 1, you would have had the whole year
Yeah.
to lose money like you have been so far.
My daughter looked at hers. Wait, you put that money in there and it's gone down? Yes, it's gone down.
Yeah, it does that sometimes.
You're 17 years old. You don't care. In fact, you'd like it to go down because I buy more shares.
Exactly. Thank you.
It's hard for people to understand.
No. Listen, all of you who are younger than 65.
7.
60. Okay.
9.
Time is your friend. Therefore, down markets, if you are continuing to contribute to your retirement, are good. Down markets are your friend. It means you're buying more stuff with less money.
And you and I are still doing that. We're still doing
I'm
that.
still doing it, and
Yeah.
I'm over 65.
Yeah. You're rapidly approaching that
Shut
other
up.
thing.
Shh.
Okay.
Quiet.
Daniel writes us from Bedford, Texas.
I
Says,
don't
"Hey,
know
guys."
where that is either.
Okay, I'm not going to ask you this time. Love your podcast. Big fan. Thank you, Daniel. We'll be doing our annual rebalancing, but found that our Roth IRAs do not have in them to buy the necessary AVUV, which is the Avantis small cap value US for the small cap value. Currently, both of our Roth IRAs are fully invested in AVUV, but it still won't be enough when it comes time to rebalance because he's talking about asset location, right? He owns small cap
Asset
value
location.
there.
Right.
Okay.
Right.
We don't have traditional IRAs, and the remainder of our retirement funds go in the 401k with no good small cap options. So,
Which stinks.
where do we get the rest of the small cap value that we need? I found that my wife's 401k at Fidelity does allow for brokerage link, which would allow you to go
Which would allow you to buy it there, yes.
Yep.
And
But
that for free. No
well,
spreads,
yeah, but generally either they charge you for the fund or the service. They get you.
No, because these are ETFs.
No, you didn't let me finish. The plan restricts it to mutual funds only.
Oh,
And all mutual funds have high transaction fees unless you go with Fidelity Mutual Funds. I believe FISVX, Fidelity Small Cap Value, would be a transaction-free mutual fund we could use. How does FISVX stack up against AVUV? It seems like the best, but not an ideal option. Wanted to bounce it off y'all before you make a move.
It's not AVUV. It is an index. So therefore it will give you the small cap marketplace, the whole thing. Whereas AVUV is going to tilt a little more value and a little smaller. But this fund is a small to micro.
Really?
Yeah.
What's the expense ratio?
It runs pretty small. It's a little less value-y than the well, no, it's value-y. Yeah. No, it actually, wow, I'm just looking. It runs smaller
What?
than the index. How is that possible? Because it calls itself an index, but it actually
FISVX. Huh.
Yeah, it runs a lot smaller.
So sounds like you're okay with a fund.
Yeah, it may have an AVUV-ish tilt. It's got more stocks in it than AVUV.
Yeah.
The expense ratio is terrific. It's 5 basis points.
5?
5.
Wow.
Man, that is a good-looking fund.
It's not going to have some of the factors in it that
at first,
the AVUV would.
Right, but it's a very impressive, very small. I mean, bear in mind, this is very small value, and therefore it is going to be volatile. And it's U.S., so it didn't have a great year this year, down about 14% year to date.
Yeah, that's about right, though.
Yeah, down about 14 in 22, but it's not a terrible looking choice. The other thing you can do too, remember, because with ETFs, there is a bit of a tax advantage in that they don't distribute capital gains generally.
Not going to matter much in your retirement fund.
No. But in a regular brokerage account, you could add some there if you had other money that you wanted to invest.
But no, you could use that fund though. If you could use brokerage link and buy that fund. Yeah,
it's a good fund.
Okay.
I got no problem with it.
There you go. Y'all come back now. You hear? So there
Bedford,
you go.
by the way, is
hello Bedford.
Bedford is northwest of Dallas, northeast of Fort Worth.
I'm still trying to figure out where Duval is. So can we just leave it at that?
You just keep driving east.
Get out of your car. You're like, where the hell am I?
When you cross a river, you're there.
That's true, by the way. Yeah, assuming it's crossable.
Yeah.
Because there are days it's
assuming
not.
the bridge works.
Yeah. Okay. Anyway,
Is there
great
anything else you want
question.
to add?
A lot of questions. Thank you. Keep them coming. I love the questions. So,
Oh my
please
gosh,
do.
I've had a lot of questions
Me
for
too.
the Friday
Yeah.
show too.
Been
A
good.
ton, and some really, really good ones.
Yeah.
Some really good Friday questions. So
Yeah. And for those of you who would like additional help, get it. And not just the professional help Don was referring to, because we don't do that kind of work.
we don't.
I don't think so. Dr. Phil's doors down the left.
Oh, we do professional money work.
Money help. But yeah, build the right portfolio, rebalance, keep it in, and just get rid of all the stuff that's driving you nuts. So we'll analyze it for you free.
All right, and remember, Clueless is smart. The market won't care. Stick to the plan and always beware.
Ooh.
Low cost, widespread, futures unknown. Buy, hold, rebalance, leave timing alone.
I'm doing the jazz hands. Is that better? Okay.
And we're singing real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.